Trying to save for your child's future but not quite sure where to start or where to actually put the money so it grows? Well, you're definitely not the only one. And the good news is you've got more than a few great options to choose from. In this video, I'll walk you through 7 practical and proven ways to save your child's money in Singapore, from flexible accounts to government-supported plans and long-term wealth building tools. We'll talk through how each one works, what the pros and cons are, and who each option is best suited for so you can choose what fits your family best. Hi, I'm Fer from Dollar Bureau, a personal finance platform that talks about insurance, investments, and financial planning. Let's start with one of the more structured long-term options, the endowment plan. Endowment plans are savings policies with a fixed term, typically 10, 15, or 20 years, where you contribute monthly or yearly. At the end of the term, your child receives a lump sum payout which includes your capital and even bonuses. And because it's also an insurance product, it provides financial protection if anything happens to you. This makes endowment plans a great choice if you're saving toward a specific milestone like university tuition. The pros of an endowment plan is that it encourages disciplined saving, offers life insurance coverage and decent growth, and provides a lump sum at maturity. The cons? It's not flexible. Early withdrawals usually means losses. It's best for parents who want a hands-off long-term savings plan with protection included. Here's a tip. Check the insurer's historical bonus payout rates before signing up. That gives you a better picture of real-world returns. Let's say you want something more flexible though, a place where you can save and dip in when needed. That's where a simple high-interest savings account comes in. This is as basic and beginner-friendly as it gets, a bank account for your child. Now, don't look for a kid's savings account, look for a high-interest savings account. The difference in interest is what makes this an attractive option for your child's savings. You can access the funds anytime, which makes it ideal for short-term savings like enrichment classes, pocket money, or emergency expenses. The advantages? They are safe, easy to manage, and fully liquid. Cons, the interest, although it's high, might not be the best, and it's not ideal for long-term goals. It's best for parents who want full flexibility or want to help their kids learn how to manage money early on. My tip is to set up a recurring transfer, even $50 a month, and show your child how to grow their savings over time, and it's a great teaching tool. But if you're thinking ahead and want something safer with slightly better returns, then the Singapore savings bonds are worth considering. SSBs are government-backed and super low risk. You start with as little as $500 and the interest increases the longer you hold for up to 10 years. And the best part, you can cash out at any month with no penalties. This gives you flexibility and a peace of mind. The advantages is that it is very safe, it's flexible, and gives fairly okay returns over time. The cons are that the returns are still modest and interest rates vary each month. And these are best for parents who want to safely grow savings over the medium to long term without locking away their money. You can use SSBs as a way to park bonus income, ang pao money, or cash you're not using immediately. It'll work harder for you than just sitting in the bank. Now, if I told you the government would match your savings dollar for dollar, would you take it? Because that's exactly what the CDA does. That comes savings option number 4, the Child Development Account, also known as the CDA. The CDA is part of the Baby Bonus Scheme. When you save money into the account, the government matches it dollar for dollar up to a cap depending on your child's birth order. That's up to $3,000 for your first child and even more for your second or third. The funds can be used for things like preschool fees, vaccinations, or medical expenses, as long as it's at a approved institution. The biggest advantage? Government one-for-one matching. You can't beat this. It's literally free money. Funds go toward essential child expenses and it's available from birth. The cons are that matching is capped and ends when your child turns 12, and funds can only be spent at approved places. The CDA is best for all parents with newborns. It is one of the best low-effort ways to easily double your savings. Here's a tip. Try to reach the full matching cap as early as you can. The sooner you hit that amount, the more you can use it over the years. I have a post that talks about the Child Development Account. You can read it in the description below. Now, what happens to the CDA money when your child turns 12? It rolls over into another powerful account, the PSEA. So number 5 is the post-secondary education account, known as your PSEA. The PSEA is designed to support your child's education after secondary school, things like university, polytechnic, ITE, or even approved overseas courses. Any leftover money from the CDA rolls into this account and it earns 2.5% interest, just the same as your CPF OA. You can also voluntarily top it up if you want to build your child's education fund further. The PSEA supports education expenses, earns solid interest, and remains open until your child turns 30. Take note that funds can only be used for education, so no access for other needs. Parents planning ahead for tertiary education, especially for those whose kids may go to poly or uni, the PSEA is an excellent place to save for your child's future. Now, if you want to help your child buy their first home or give them a boost in adulthood, that's where number 6 comes in, CPF OA Top-Ups. Topping up your child's CPF OA may sound unusual, but it's a smart long-term move. The money earns compound interest and can later be used for university fees and HDB down payment or even retirement. It's not money you'll touch soon, but it gives your child a serious head start later in life. The pros are that it's meant for long-term growth. I mean really long-term, because your child cannot withdraw it unless it's for university fees or buying a home. The compound risk-free interest rate of 2.5% is an unbeatable place to save for your child. The cons are that the funds are locked in and you will not be able to withdraw it easily. This is best for parents with a long-term mindset who want to quietly build wealth for their child's future. If you're looking to grow your money in the short term, there's one more tool worth knowing: T-bills. Singapore T-bills are short-term government securities, typically 6 or 12 months. You buy them at a discount, let's say $919, and get $1,000 back when they mature. They are backed by the government and you can invest using cash, CPF, or SRS. It is low risk, relatively short duration, and better returns than savings accounts. The cons is that rates vary with each auction, returns are modest compared to long-term investments, and they are best for parents who want to temporarily park money while earning slightly better returns. Use T-bills for money you won't need for 6 to 12 months, such as school fees or insurance premiums, to earn a bit more without risk. So there you have it, 7 smart places to save your child's money in Singapore. Some give you flexibility, others help you build long-term wealth. The smartest approach, a mix of both. Start with what fits your needs today, stay consistent, and adjust as your child grows. Every dollar you set aside now could open up a world of opportunity for them later. If you want to learn more about saving for your child, you can speak with one of our financial advisors. There's a link in the description below to get started. If you found this video helpful, don't forget to like, share, and subscribe for more practical financial tips. Thanks for watching. I'll see you in the next video.